Hello viewers, welcome once again to our show. This is none other than your host, Mr. Spotter Fred. So today's session, we are going to look at advanced financial reporting, and remember, we want to develop the group accounts. From the previous sessions, we have introduced group accounts, or rather we call it consolidation. So we are talking about group accounts. As we must have said earlier, group accounts can also be referred to as consolidation, can also be referred to as business combination. We looked at the various standards that are going to guide us in the preparations of the group accounts, in the adjustments. You know, we talked about IAS 27, we talked about IFRS number 10, we talked about IFRS number 11, we talked about IAS 28, we talked about the IFRS number 3. We talked about IFRS number 5. Those are some of the items we discussed as we were introducing the group accounts. We introduced it initially from the previous sessions. Remember, we looked at where an acquisition is at 100%. What happens? That the date of acquisition is the same date of consolidation and the acquisition is at 100%. We also looked at a scenario whereby the acquisition is at 100%, but the date of acquisition is not the same date of consolidation. We also looked at in other subsequent scenarios where the acquisition is less than 100% and the date of consolidation is not the same date as acquisition. Then we looked at a scenario whereby we have not been given the investment, the cost of investment had not been accounted for in the books of accounts. So we have looked at those four scenarios. Those four scenarios, how we were coming up with the non-controlling interest, how we were coming up with the pre-acquisition retained earnings and the post-acquisition, and what we were required to do, how we were required to account for the cost of investment if it was not brought into the books. That is something that we have done, friends. Now, today, we want to develop this topic further. Remember, in the previous sessions, we have only simply looked at ordinary share capital, where the holding company has acquired ordinary share capital. Then we have not talked about where the preference shares have also been acquired, or the debentures have also been acquired. We have not talked about that. So today we want to go further and look at other balance sheet adjustment. Remember, we are still talking about consolidation of a subsidiary, where we are talking about accounting for consolidation. Accounting for a subsidiary. Accounting for a subsidiary. Don't forget, we had introduced this. We are talking about preparation of a group balance sheet, a group statement of financial position, statement of financial position. Remember, we are talking about how do we prepare a consolidated statement of financial position. In that case, don't forget, when we talk of a consolidated financial statement or statement of financial position, we are simply looking at the balance sheet of the holding company and the balance sheet of the subsidiary. That's what we want to look at. Now, in that case, we have looked at several scenarios, but this time around we want to talk about other balance sheet adjustments. We want to look at other balance sheet adjustment. But we cannot look at other balance sheet adjustment without also trying to remember what we have been talking about, without taking into account what we talked about in our example 1, 2, 3, and 4 in the previous sessions. So remember, this is a continuation from the previous sessions. So we want to look at maybe example 4, example 5, 6, 7, and that is what we'll be looking at to develop this topic. We are still looking at balance sheet. One of the other balance sheet adjustment is the preference shares. The preference shares in the subsidiary. What do you do with the preference shares in the subsidiary? Now, these preference shares in the subsidiary may be acquired or they may not be acquired. We may not be very much interested with a scenario where they were never acquired. We'll be interested because if they were never acquired, there's nothing much we do. But if they were acquired, then if they were acquired, amount paid. If acquired, amount paid to acquire, amount paid to acquire preference shares, amount paid to acquire preference shares as a purchase consideration will be part of purchase consideration, and this purchase consideration will be used to determine our goodwill. Now, remember, we also talk about the group share. The group share of preference share capital based on preference shareholding will be part of the net assets acquired by the holding company. Meaning it should be used to determine our goodwill in the cost of control. Then you need to remember that the NCI share, non-controlling, the NCI is the non-controlling interest, as we must have said from the previous session. Non-controlling interest share of preference share capital, don't forget, based on preference shareholding will be credited to non-controlling interest account. Alternatively, it should be recognized as part of the net assets due to NCI. Don't forget that. And in other words, you also need to remember that the NCI net assets should be reported in the statement of financial position to reflect what non-controlling interests have also financed in the group. Now, you need to remember this, friends. In case of redeemable preference share capital, then the NCI share will not be reported to the non-controlling interest account. You should remember that. But in case it's just preference share capital, fine, no problem. But in case of redeemable preference share capital, the NCI share will be recognized as a non-current liability. That's all. Then we come to the other item. We talk about debenture. We talk about debenture. You know, we may have debenture, redeemable, preference shares, or loan stock, and etc. Those kind of items in the subsidiary. What do you do in that case? For the element of the debenture, redeemable preference shares, loan stock in the subsidiary, what do you do about them? How do what adjustment would you do? Now, if acquired, in case the debenture or redeemable preference shares or the loan stock was acquired by the holding company, then amount paid to acquire the debentures all the debentures, redeemable preference shares, the loan stock behave the same way, will be recognized as part of purchase consideration. Meaning, if an item is recognized as part of purchase consideration, then it will be used to determine goodwill. You also need to remember that the group share of debentures based on debenture holding percentage will be recognized as part of the net assets acquired. So very importantly, that will be part and parcel of the net assets acquired. Then NCI share. The NCI share of the debentures. Friends, one thing you need to not to forget, when I talk of debentures, I talk of redeemable preference shares, I talk of the loan stock, they behave the same way. So the NCI share of the debentures, redeemable preference shares, the loan stock will be recognized as part of the NCI net assets, thus credited to the non-controlling interest account. That's important. So those are very, very important items that you need not to forget. So we have discussed about preference shares. We have discussed about debentures. Now we want to look at an illustration question and see how will they behave if there is an acquisition of the preference shares, there is also an acquisition of the debentures. What will happen in that case? So that's exactly what we want to do. So there is an illustration question, as you can see. Example number 5. We are looking at example number 5. Example number 5. Now, the following is the balance sheets of the two companies as at 31st December 2015. We have been given two companies. One is Tamim Limited and the other is Mima Limited. We have been given non-current assets, property, plant, and equipment, as you can see it. We have investment in Mima Limited. We have the current assets, inventory, accounts receivable, cash at bank. We have the total assets. We have the equity and liabilities. There's capital and reserves, ordinary share capital. We have the 10% preference share capital. We have the share premium. We have the retained profits. We have non-current liabilities. There's a 10% debentures. There's also a 15% redeemable preference share capital. Current liabilities, we have accounts payable. We have the total equity and liabilities. Additional information. 1. Tamim Limited acquired 70% ordinary shares of Mima Limited on 1st October 2005 when the retained earnings was 40,000 shillings. 2. Tamim Limited also acquired 20% preference shares of Mima Limited on 1st October 2010. 3. Tamim Limited also acquired 40% debentures in Mima Limited on 1st January 2015. Then we have been told required, prepare the consolidated statement of financial position as of 31st December 2015. Now, from the required point of view, we are required to prepare the consolidated statement of financial position as of 31st December 2015, meaning our financial year begins on 1st January and ends on 31st December 2015.